Hello, this is Jordan, and this is your Precious Metals video market update. This video is being recorded very early Thursday morning Eastern Time, September 3rd, 2015. And first, I want to look at how gold is performing against various asset classes, namely gold against global equities, foreign currencies, and commodities. Now, gold relative to foreign currencies has already bottomed. It's weak here in the near term, but I do believe the low from the very end of 2013 is in place. Next, gold against commodities has been very strong. I mean, last week that almost touched the all-time high that it made in early 2012. And as we've been saying for a long time, the real key is gold has to break out against stocks. That could be a huge, if that happens, it could be a huge indication that the bear market is over. And that ratio there at the top, it's gold against the all country weighted index. So it's like a global index, or ETF actually. And you can see that the ratio spiked up from the beginning of August to last Monday. It was actually up 20%, so that's quite a move. It's pulled back. It's consolidating a little bit. It's been up so far this week, but we can see that hit a confluence of resistance. It hit the trend line resistance and the 400-day moving average. So the last time that ratio traded above the 400-day moving average, or even tested it, was approximately 3 years ago. So this is something to keep an eye on, of course. And next, we're just taking a deeper look at this gold against equities. Specifically, at the top, we have gold. That's just gold's nominal chart there. And we have gold against the ACWI, then the NYSE, and then emerging markets. We can see that gold against emerging markets has already broken out. I mean, as of last Monday, that was at close to a 2-year high. It was more than a 52-week high there. So gold has turned against emerging markets, and that's important because emerging markets really have led this move down in global equity markets. So that could kind of be a leading indicator. And of course, as you see here, we have gold against the NYSE, kind of the biggest, broadest index for U.S. stocks, and then the global index, the global ETF, ACWI there. I mean, look at both those trend lines there. You can see that those ratios are bumping up against important resistance. So again, like I said the last time, I mean, this is really something to keep an eye on because this could be a major, it could hint, if we see a breakout in these ratios, it could be a hint of a major trend change for gold. And I mean, that could happen even if gold is declining and declining towards $1,000 an ounce. I mean, more important to me here in the next month or two is how is gold performing against stocks. We want to see gold start to outperform stocks. We want to see these ratios break out. If that happens, then very good things are going to be coming soon for gold, in the months and quarters ahead, regardless if it goes down and tests $1,000 or 970, over the next month or two. Now let's move on and talk about the miners. Here we have the weekly candle chart for GDXJ. That's at the top. GDX is at the bottom. But one thing I want to look at closely is the candles of the last couple weeks in yellow compared to the action around the lows in late 2014. Now, if you go back, you can see the arrows there. Look at the white candles there. They're strong white candles. The market closed near the high during those up weeks, and so that's very positive relative to what we had happen in August. Look at those two white candles in both GDX and GDXJ in August. The market rebounded, it traded higher, but the market wasn't able to hold most of the gains heading into the weekend. So that's a sign of distribution when the market is unable, it's rebounding or going up, but it's selling off, it's pairing its gains for the week. So, and in addition to that, we can see that if you look at the candles in July, I mean, other than that, the first one that made the low, um, those reversal candles, which are called hammers, you can see them in just start at August and go back. Look at the last three candles, those three black candles. They're reversal candles, but they're really not that strong. I mean, look at the ones in December. I mean, those are strong bullish hammers, and then that was validated by the fact that the next week both markets went up, closed at the high of the week, and then that basically happened again for another week. So it's the action that we see right now is just it's really weak in the context of a market that's extremely oversold and should be rebounding much more strongly. I mean, look at GDX. It wasn't even able to get up to 17. So, I mean, there's just all these little things here, just signs of weakness and signs that this is not a major bottom or even a double bottom. I mean, if this was a strong bottom, you would see miners exploding up through the resistance at the red lines. I mean, over the next couple of weeks, you would see the market exploding up through that very quickly. And so just, I mean, what we've had over the last 5 or 6 weeks, it's just, I mean, it's a really oversold market that is kind of, digesting the losses and consolidating that before another move down. So, I mean, this just does not look bullish to me whatsoever. Now, zooming in on the short term, here's a daily chart of GDXJ. Now, we can see that there's a major confluence of resistance around 23. You got the trend line, you got the lateral trend line, and then you have the 200-day moving average, which is at 24, but going down a little bit. So currently, GDXJ closed just below 20. The last couple days, it failed at 21, so that is key resistance right now in the very short term. Support is obviously at 18. I mean, again, if a bull market was about to begin, we would see GDXJ explode up through 21 and then 23 without a problem, I mean, in the next couple weeks. And one thing is that sharp decline we had a couple weeks ago from 23 down to 18, which happened in about 4 days. The volume on that was pretty strong. It was pretty heavy volume. And meanwhile, the recovery that we've had has not been on as strong a volume. So, I mean, these are just more worrying signs. So, again, very short term, it's a range from 18 to 21. I expect it's probably going to break below 18. Even if it breaks above 21, I think that could be a bull trap and trap some bulls thinking it's a breakout, it's bottom, it's about to go a lot higher. And in addition to these comments, but before I close, we don't have charts for the metals in this update, but both gold and silver, I mean, they've rallied a little bit the last several days, but they look vulnerable to me. They look like they could start to begin another leg down. And look, they've held up better than the miners recently, but that's not what we want to see. Now, going to the bottom of the chart, I have some ratios here. I have GDXJ against gold, GDXJ against the stock market, and then silver against gold. So looking at these ratios can be leading indicators for the sector. And so two of them basically look bearish and only one of them looks bullish. And so to get back to what I'm saying about the metals, looking at the metals, I think they're at risk of starting a new leg down here, or at least kind of consolidating in a bearish fashion over the next week or two. And gold, that $1,000 target at gold for gold, still a very, very strong target. And I expect that's going to be tested, and that just confirms my thoughts that I don't think the miners have bottomed. So continue to be careful, continue to be safe out there. We are giving away our book for free. We'll send you a PDF file and also an ebook file. Go to the address below, thedailygold.com/book, and opt in, and you'll get the book. Follow the instructions. You'll get the book emailed to you, the download links instantly. And that's all for today. You can follow my work at thedailygold.com. You can also sign up for my free newsletter there, and you'll get a link to the book, as I just said. And that's all for today. Thanks, everybody, for listening and watching, and we'll talk to you again in the next week or two.